Good morning. You're watching Business Plus. Here are the top stories we are tracking at this hour. Farmers march to Delhi once again. More than 200 farmers' union are heading to Delhi today, demanding legal guarantee to MSP for all crops. Security measures at Singhu, Ghazipur and Tikri borders intensified. Traffic advisories have now been issued. And in good news for India, retail inflation eases to 5.10% in January, while unemployment rate in urban areas falls to 6.5% in the month of December, indicating a strong macroeconomic picture. RBI sticks to January 31st order against Paytm. RBI governor says no review of action against Paytm. Payments bank to stop accepting deposits or top-ups in customer accounts come 29th of February. We're tracking all those stories here on Newsline. I'm Shweta Kothari. With me is Kartik Malhotra. Hi Kartik, very good morning. The biggest story, of course, the entire country is tracking at the moment is that big farmers' protest. Once again, farmers are now heading to Delhi. Security has been intensified all across the borders from Punjab to Haryana, Haryana to Delhi. Traffic advisories have been issued, schools have been closed down, roads are, at this point fortified. Entire security apparatus in the state as well as in neighboring state has now kicked in to ensure farmers don't reach the national capital. What exactly are farmers demanding at this point?
So, I mean, amid all the issues you mentioned, Shweta, and the fact that Delhi has been fortified and there are concrete and metal barriers placed in all entry points into Delhi, I think the barrage of people walking in, marching in, the sea of cars, there is obviously chaos, and that chaos is what the government is trying to arrest at this moment. Now, while there is obviously a disruption part of it, there is also political angle to it, but I think it's important to understand the economics of this. So, what are farmers really demanding this time around? I think farmers are very clear that I'll tell you how this is actually different from what happened in 2020, 2021 and now. So primarily, I think, why the farm laws of 2020, 2021 were repealed was primarily because farmers did not want the government security on procurement of their produce at a certain price to go. The government wanted to offer free and fair market prices at mandi, minus the mandi tax, minus the middlemen, so that farmers' produce could go and fetch whatever is the relevant current mandi price. And that mandi price would be dependent on the vagaries of market. So in a low monsoon year, when crops are low in production, there would be a higher demand for fewer grains, and those fewer grains would then fetch the farmers a higher price, right? As opposed to an MSP under which the government is going to procure that from you, and no matter how good or bad the crop cycle is, or how the yield on the farm has been, there would be that minimum price that the government would pay, and the negotiation between farmers and the government, or the buyer and the seller in a pure economic term, would be reduced, right? So actually the government, what it said in 2020, 2021 was that this is a pro-farmer sort of a rule law being enacted. What the farmers perceived it to be was that the government support and the government's hand over offering at least that minimum security to farmers is getting pulled away. So that was the crux of the issue back in 2020, 21. Eventually, the farmer side won and the government had to repeal those laws. Right?
Absolutely. But the guarantee on MSP, and that needs to be enacted in the law. That was also one of the demands in the farmers' protest of 2021. That hasn't been met just as yet.
So, I think the government has also been promising the doubling of farmers' income. MS Swaminathan, the late MS Swaminathan, just conferred with the Bharat Ratna, also had come up with this formula called C2 plus 50%, which is primarily the MSP should be based on a pricing which takes into account the fixed cost, which is the land, either the land prices, ownership of the land, or the rent that farmers pay on the land, and all the variable cost.
Labor.
Yeah, so all the variable cost for every crop production cycle. So let's say you're producing wheat, you're producing paddy, you're producing pulses on the same, arguably on the same piece of land, even though different pulses and different wheat and different paddy crops require different climatic and water conditions. But assuming that all of that is being produced on the same mass of land, then on that land, depending on how much wheat, how much pulses, how much rice is getting produced, you weight it out over the overall production. So the weighted average cost of production for the yield on the land plus all the fixed cost accrued over years onto producing that particular output to be taken into account as the weighted average cost, and then add a 50% on top of that. Now, I mean, MS Swaminathan has done great work for, for the farm community, and I'm sure there would be a lot of logic in what he had proposed. But as a student of economics, it's hard to believe that any industry works on a 50% margin. What is being promised here is that whatever your cost of production is, add 50% of that and make that the minimum selling price, the MSP, on which the government is going to procure it. Now, obviously, that is going to dent the coffers of the government. The government's own expenditure on procuring essentials like food grains and vegetables is going to prohibit that 50% delta over the cost of production. So this is one part of what the farmers are demanding this time. So they want the MS Swaminathan Commission, rules to be finally formalized, and the C2 plus 50% formula gets implemented as MSP. In addition to that,
there are other demands as well.
Yeah. So in addition to that, there is demand for pension. There is demand for debt waiver. Now all of these are going to again add to the expenditure of the government and the economic burden of the government. So that is going to be difficult for the government to agree, simply because we have our own fiscal deficit targets. We have our own calculation done on how much we are going to get by way of taxes, how much can we spend by way of SOPs. Farm income in any case happens to be tax-free. So the government is not earning anything out of the farm sector. It needs to, as per the demands, pay that 50% markup on the average cost of production. And then these demands of debt waiver, demands of pension is something which is obviously going to burn a large hole in the coffers of the government. In addition to that, what the government now seems to be agreeing to somewhat is that the farmers want the cases against the protesters of 2020, 2021 to be withdrawn. Right. So that is something where the government may be able to play a softball, may be able to come up with some sort of a negotiation and give in to the demands of the farmers. But overall, I think all these economic costs which the farmers are demanding, it's going to be difficult for the government to match up. And the complexity increases because we are again right in the forefront of the upcoming election season, and farming being a large political community and a large vote bank, is going to be difficult for the government to match up to their expectations or negotiate a way out of their demands one way or another.
All right. So negotiations have been on for a while now, and since negotiations failed to reach any conclusion, hence which the farmers are now marching. In fact, we are now told that they have started marching to Delhi from 10 a.m. onward. We'll try and get you more visuals of how the traffic is panning out in Delhi NCR region. Borders have been closed down at this point. But, since we're discussing the economics of it, economically, it does not make any sense at this point in time. So, of course, the minimum guarantee on MSP and the fact that that should be a part of the law is what government agreed on even back in 2021.
That's right.
But all the other demands, so to say, the demand for pension and debt waivers seems new.
So, yeah, I mean, it definitely
extraordinary.
Yeah, so this is definitely an addition to what the conflict was or what the clash was back in, 3 years ago, 2020, 2021. But, again, I think MSP or any sort of incentive that you want to give, any scheme that the government rolls out, there has to be a definite time frame for that. I mean, you want this MSP to be set at C2 plus 50% for how long? So there has to be a time frame.
But government way back in 2014 did promise a minimum guarantee on MSP. In fact, farmers are suggesting even that promise has not
So I think the formula that the government has used is not the formula which has been suggested by MS Swaminathan. Right. And the farmers believe that the government has tried to hoodwink them by tweaking that formula and arriving at an MSP which is actually not giving them an additional 50% over their weighted cost of production, which MS Swaminathan had suggested. So I think overall, again, whether you follow Formula 1 or Formula 2, there's another formula also which is A2 plus FL. So, I mean, I don't know how that is calculated. Again, I think that is on the basis of the appreciated farmland prices. But broadly speaking, I think if there is a time frame set, how long do you want the government to incentivize the farm sector?
Absolutely.
It is in any case tax-free. You won't give this waiver for a year, for 3 years, for 5 years, for 10 years, forever.
Do you want to give it at all is also the question, because the government is not relenting at this point.
Absolutely. So I'm saying, if you want to make sure that you have given yourself a target that in the next 5 years, you want the farmer income to double, farm income to double across the board. It is one of the constituencies of the Modi government right now. Modi's guarantees for a Viksit Bharat come on the back of the farming community, come on the back of women, which are 50% of the agriculture labor force. So broadly speaking, I think it is going to be difficult for the government to have an indefinite MSP and an indefinitely large formula of 50% more than actual price cost of production, and if there is no time frame set to that, then it's going to be difficult to introduce some sort of an incentive right now and withdraw it post elections, withdraw it after 3 years, withdraw it anywhere in the next 5 years as you head to the 2029 elections also for that matter.
But taking a cue from what happened in 2021, which is the government for many months did not relent, even when farmers were here in the Tikri border, they were in the Sindhu border, they were at Red Fort, they were here for months on stretch, and this was at the peak of pandemic.
Winters and winter months, it
peak
was
of
cold.
Winter months.
True.
And months after that, we heard Prime Minister finally giving in to the demands, caving into the demands. It does not look like that may just happen.
I think, the giving in at that time, Shweta, rightly so, if I could add, was that you repeal the farm laws which were not conducive as perceived by the farmers in their interest.
Right.
So you've repealed those laws which you had newly enacted. Right. So that is one part of it. The other part is this demand for MSP at 50% additional over the cost of production is something which the government is going to find a financial burden to uphold and adhere to for years to come. So I think that negotiation has to come through by the basis of derivation of an equally conducive formula which the farm community will also agree to and the government will not burn too much of a hole, and some sort of a definite time frame.
Absolutely.
Beyond which those subsidies would go.
All right, but it looks like the government does not want farmers to march to Delhi, at least today. There is heavy fortification of Delhi. We continue to get you all those visuals where farmers are hoping to move to Delhi starting 10 o'clock this morning. Visuals on your screen suggest that there is, in fact, borders which have been sealed at this point between Haryana to Punjab and Haryana to Delhi. Government does not want farmers to move Delhi. It does not look like a right appropriate time. Also, this comes on the back of elections, the much awaited general elections, Lok Sabha elections in about 2 months from now. So it's not a very good picture for the government of India. But farmers there, of course, demanding a minimum guarantee on MSP and a debt waiver, as well as a pension to go forward. Whether these demands will be met favorably, we don't know, but the current conversation between the Government of India, Union Government, as well as Farmers Union, 200 of them, is currently on. We'll try and get you all those details throughout the day today. But with this, it's time for a short, quick commercial break. We'll be back in just a bit.
For the very first time in our investigation, we unmasked the killer of Ravindra Matre.
In 5G, we have to stand with the world, and in 6G, we have to lead the world.
Winning a Grammy was an absolutely surreal experience.
In our previous episode, we took you around the city where we witnessed the chaos of Bengaluru's roads, the frustration of commuters, and the everyday battle of a Bengalurian.
We are traveling again from KR Market to Whitefield. But this time we are not doing it in a car, but we are doing it in Bangalore's lifeline, the metro.
Bangalore traffic is an example of something that has gone wrong with our system.
We have more than 50 flyovers in Bangalore city. If flyover is a solution to traffic problem, Bangalore should not have traffic problem.
According to TomTom Traffic Index 2022, Bangalore is ranked as the second worst city in the world when it comes to traffic.
The speed limit at the ORR is 80 kilometers per hour, but our vehicle has only moved 10 kilometers per hour.
What Bangalore needs is a surgery, but what we have been offered repeatedly are band-aids.
Only on the world's first news OTT, News 9 Plus. ahead of the curve.
वर्ष 2070 तक भारत नेट जीरो का लक्ष्य हासिल करेगा।
There's certainly a wall of capital coming into the clean tech, climate tech space, not just in India but across the world.
This and more, streaming on world's first news OTT, News 9 Plus. Download now.
जानना है तो देखिए, समझना है तो सुनिए, सीखना है तो पूछिए और कमाना है तो खरीदिए। जानकारी, सलाह और निवेश सब एक ही सुपर ऐप पर। पैसे का सवाल है तो जवाब है मनी 9। आजादी पैसे की, अभी डाउनलोड करें।
Welcome back. You're watching Business Plus. In what spells like good news for Indian government as well as for India, retail inflation has eased to 5.1% in the month of January, while unemployment rate is also contracting, especially for urban areas, which has fallen to about 6.5% in third quarter of financial year 2024. Kartik, a variety of parameters. All of these parameters, of course, hinting at a very strong macro picture for India. Let's talk about inflation. 5.1% in the month of January, and quite in line with what the government was expecting. In fact, better than what the government was expecting and what many analysts were hoping. January, traditionally a month where inflation has been higher in the past. This would ensure that the overall inflation for the year 2024 will be in line with government estimates.
Yeah, I mean, it's difficult to say, Shweta, because, you know, most economists were hoping that if the government wants to stick to the quarterly average of inflation coming at 5% and the annual average for inflation for FY24 coming in at 5.4%, then there were economists out there who were hoping that we will see a below 5% number emerge for the month of Jan. But at 5.1%, it is still higher than what it was expected to be. So at 5.1%, it is better than what we saw in December, but still above 5% means that we will have to make sure that between Feb and March, we will have at least
average
1 month.
4.9%.
We will have at least 1 month where we will have, no, in fact, I think the weighted average will have to be a little lower than 4.9, but we will need 1 month where it comes well below the 5% mark for the quarterly average, Q4 average, to come in at 5%. But, you know, unfortunately, there aren't too many levers left with the government to tinker around with anymore, because the 6.5% RBI repo rate has been fixed for the last 6 months, 7 months or so now. So, you know, any correction beyond that, any increase of rate above that to bring down hemin inflation is going to be counterproductive to industry. Now, at the same time, what is driving this headline inflation is, again, food prices. So, vegetable inflation, for example, has come in at 27%.
Still a double digit,
double
close
digit,
to 30%.
and how? It is 27%, right? So, that's a huge disruptor to the overall inflation trend. Now, look at pulses inflation. Pulses inflation is also coming in at about 19%, which is also well into double digits. So, I mean, these are things that the monetary policy cannot do much about.
Absolutely. So, in which case the government at this point does have some leeway, some wiggle room to perhaps tinker with the fiscal policy, put more money in the hands of people. With, you know, pulses specifically, we've seen government taking a very proactive measure, coming out with portals to procure pulses, your tur dals, and ensuring also essential grains like rice, atta is made available at a discounted rate. If that policy, which is kicked in the month of December and January, were to come into fruition and some results are to be expected in February and March, there's still room to get that inflation for the quarter under 5%.
Excuse me, one would hope so, Shweta. But again, I think the problem is you've got to do the balancing act between your fiscal deficit as well as what the monetary policy does. So I think the fiscal policy, monetary policy will have to work hand in hand.
Absolutely.
But 5.1% overall is okay. It is still well above the 4% threshold that the RBI wants to hammer it down to. And the volatility in food prices, even with these portals coming in, even with some sort of an agreement upon MSP, is not something which the government will be really able to contain in an immediate measure. These are things that may work over a longer horizon, 6 months to 1 year.
Okay.
But right now, for the year to close at 5.4%, for Q4 to come in at 5%, for the year to close at 4.8%, 5.1% still seems high when there are no indicators right now that there is going to be a cooling off in vegetable prices, in fuel prices in the month of February and March. So if that doesn't happen, then the target to meet even a 5.4% for the year, and then the subsequent expectation of rate cut in 6 months, in 8 months, 9 months from now is going to become that much more distant. So that is as far as the inflation story goes. Secondly, I think even globally, who's going to take the lead in rate cut? So whatever the government can control by way of rate pause or rate hikes has been achieved. Food and oil you will not really be able to do no matter what the rates are. So I think the question RBI would perhaps be considering right now is that will cutting down on rates over the next 2 months, 3 months, 5 months, 6 months horizon, will it impact all the other factors of inflation, keeping the volatility of food and oil
basket
at bay?
Right.
So if that continues to be outside of the control of RBI, then perhaps because a little bit of cut is something that the RBI could...
inflation is looking,
absolutely.
it's no more sticky at the moment, and I think well within government's range.
What is spoiling the large number is the vegetable pulses and the overall food
there's
inflation.
very little that RBI can do at this point in time.
Though if you look at dairy produce between milk and eggs, all that is finally getting tamed. So, milk inflation has been coming down month on month. So, overall on inflation, I think whatever could have been done by the monetary policy levers has been done. And I think it has been achieved also because core inflation is what the monetary policy can control. That has been controlled. Now, coming to the second high frequency indicator, as these are called, the second high frequency indicator coming. So industrial production also, I think at 3.8%, it is better than the data that came in the month of November, which was at about 2.8%. So month on month, there has been a good 1% jump, but this 3.8% also came on the back of a 5.1% IIP for December 2022. So again, on a high base of industrial output on a year-to-year basis, 3.8 is not a bad number. So sequentially, there is growth and year-on-year also there is growth. So this graph had been a little distorted and a little volatile over, over the course of the last 6-7 months. So you'd seen these big ups and downs in IIP because again, the comparison was in the context of the data for 2022 and 2022 is when supply chains were largely disrupted owing to what was happening in Russia and Ukraine. So there was disruption in the month of July, August 2022 and hence the base correction effect took place.
In the month of December?
So the kind of growth that you saw in IIP, so we have the data. So in the month of August, for example, IIP coming in at about 11% was on account of the low base of 2022 in the same month when the conflict between Russia and Ukraine was hot. So overall, I think these numbers on a year-to-year basis are adding up well. December 2022 is when we had seen recovery in supply chain mechanisms and industrial output increase. Now on the base of December 2022, a 3.8% increase in December 2023 is also all right. So nothing for the government to worry about. If anything, I think it is a cause for the government to think that all high frequency indicators are coming in line with expectations, hoping that the $7 trillion economy dream by 2030 is something which should be within the government's reach.
All right, but another high frequency indicator, and which is the jobs market, is also not looking too bad, especially when we talk about the periodic labor force survey. Now, in urban areas, it says that the unemployment has fallen by 6.5% in the last quarter of financial year 24. What does it really mean for youths out there? Because a lot of people we talk to very often, Kartik, are of the view that the numbers look very good, but as far as jobs availability on ground is concerned, that picture is still scary.
Right. So I think this is one of the high frequency indicators where the government needs to actually, the government and I think private, statisticians and analytics firms need to sort of partner, because I think there is a lot of conflict between the data released by EPFO and let's say the data released by CMIE, right? And CMIE's data is something which most people, who are either part of the government or seem to be siding with the government's narrative on EPFO data seem to dismiss the CMIE data now. And CMIE data paints a very different picture from what EPFO data tells us. So EPFO data tells us that unemployment figures have come down. If you remember, unemployment figures were in the 9%, 8% range in most of last year's range, and we saw that that it had during COVID, in fact, also gone into good double digits. So all of last year we saw what I think 7%. 6% or so quarter after quarter. So now that has come in at 6.5%. But again, this is EPFO data.
Right.
EPFO data is looking at formal job creation, number of new enrollments in the EPFO books, and that is on account of those who are formally employed, not contractual employees, not self-employed people, but those who are eligible to be enrolled in EPFO or the Provident Fund cycle. Now, CMIE, to my mind, looks at data well beyond formal job indicators, and that data does not come in line with EPFO.
Informal sector
Informal
that
think,
employs a major chunk of
also,
people.
so there is, of course, there's the informal side, but anecdotally also, if you look at it, the kind of hiring which was meant to happen in the IT sector has not happened.
Absolutely.
In fact, job losses across the IT
Massive
sector,
job losses,
across
quarter-on-quarter.
startups, quarter-on-quarter, we haven't seen, and even in factory employment numbers, which employs a bulk of contractual labor, we haven't really seen the kind of impetus which the government wanted to push on manufacturing in the context of China Plus One. We haven't seen that sort of an uptake in in number of factories coming up, or the number of new entrants into the GST fold who are now eligible to pay taxes. The volume of GST collection has gone up, but the number of GST filers has not gone up in the same ratio as, let's say, income tax filers, personal income tax filers, which again means that formal employment as per EPFO may be taking off, but then that is a figure which is net of perhaps job losses. New additions are happening at a faster clip, but is this data comprising of those who've been kicked out? Because you don't know, sitting as part of a machine in EPFO, whether the EPFO contribution has stopped for a temporary reason of job switch, or whether it's not likely to come back because the person fails to find a job outside of the last employment. So overall, I think this whole mechanism of looking at employment data is something
and perhaps
that
we need
to
a
see
tracker
more clearly.
on unemployment as well, job losses as well, Kartik, because we haven't really tracked those job losses concretely by virtue of one single window that government has devised. So there are various data available out there as to how many jobs were lost in startup, jobs that were lost in IT, but we don't have a concrete number. There is no calculation.
There are estimates, there are industry estimates, company level estimates, and then you just sort of do a very back of the envelope sort of a calculation. But the point is, if, let's say, hypothetically speaking, a 20 lakh rupee per annum earning employee is sacked from an IT firm and replaced by somebody who earns, let's say, 6 lakh rupees per annum, is that adding to employment or unemployment? Because the EPFO is going to look at that 6 lakh CTC employee as a net addition, not knowing that this 20 lakh exit is actually going to come back into the workforce, go out of the workforce, is between jobs. The machine cannot understand that data. So the company has replaced an expensive resource with a low-cost resource, hypothetically. So is that a cause of celebration on account of employment data adding up, or is it a problem for the country at large that there is also unemployment in equal measure?
Absolutely. I think some of those parameters need to be also taken into account. The number of people who are losing their jobs owing to layoffs, massive layoffs that we are tracking here on News9 in IT, to gaming companies, to a lot of sectors that are being closely watched when it comes to layoffs. But the story here, of course, is those high frequency indicators looking well for India, from industrial production to unemployment going down and retail inflation well within the range. It looks like the macroeconomic picture for India is emerging extremely very, very strong. But before we close this bulletin, another story that continues to make headlines by the way of Paytm. And Paytm, it appears, is not going to get any review or relief when it comes to the deadline set by RBI of February 29th. In fact, RBI governor has said that there will be no review of that deadline, and everybody who was trying to figure out what will happen to Paytm should wait for that FAQ to come from RBI. That FAQ, Kartik, perhaps could come in this week, would perhaps give us some clarity on what's happens here on and what's next for Paytm from here on.
I think, a little unlikely on that count, because again, in addition to what Shaktikanta Das said yesterday, the RBI governor said yesterday on no potential review for Paytm Payments Bank, and RBI is not going to review its 31st Jan order. It pretty much means that there is no scope for renegotiation, there is no scope for further discussion, and and this is how things are going to stay. Now, what the FAQ, I think the clarity which came from the governor yesterday on the FAQ was that the FAQ is actually going to talk about consumer-related aspects, customer-related aspects, not as much about what is going to happen to the corporation called Paytm Payments Bank Limited. So I think the FAQ, I had more hope on what the FAQ is going to reveal until yesterday, but after listening to RBI governor, I think my hopes of the FAQ really giving more details into what went wrong exactly and what is the road ahead for the payments bank, the Paytm Payments Bank, is something which the FAQ now, to my understanding, is unlikely to answer. But I think markets obviously, investors obviously are not taking well at all to this commentary coming in from RBI. And this morning again, in early trade, we saw Paytm stocks crash another 7% or so. So trading now well below the 400 rupee a piece mark at about 391 to 393 range. So so there doesn't seem to be any bullish sentiment by way of investors, both institutional and retail at this moment, on really pinning their hopes and their aspirations on any kind of a recovery in the Paytm Payments Bank business. And if the Payments Bank goes bust or the license for the Payments Bank is cancelled, then the wallet service, which has been one of the calling cards of Paytm, goes for a toss as well. And any other revenue driver which the company had installed in its march from a startup in the fintech space to a market leader, and at one point the most valued startup in India at a valuation of $5 billion, that is something which I think is now going to be history pretty much, because there wouldn't be a revenue driver for the company, and without revenue, how the market's going to view it. At the end of the day, the market cap, the market valuation of any company is an outlook of its future cash flows, and if those cash flows are going to get hit, then there is no merit in Paytm even continuing as a listed entity, or 197 continuing as a listed entity. So as I see it, it seems quite likely, more likely now than before, that the Payments Bank license may get cancelled. 197 Communication will not immediately have another pure revenue stream. Cash flows are going to get hit.
I think I'm also waiting for some clarity from Vijay Shekhar Sharma, and I think we all are, on what are its revenue drivers if Paytm Payments Bank license were to be revoked in a week following that February 29th deadline. What is going to keep Paytm up and running? Because we still want to understand, where do they get majority of their profits from? If Paytm's bank is the cash cow, and if that goes away, is there any merit in having Paytm as a listed entity anymore?
Exactly. So I think it is going to pretty much then work as a third-party aggregator of UPI transactions.
Which, by the way, there are plenty in the country already.
So the market leader becomes a Me Too player, right? So the market leader, the innovator, somebody who pretty much drew the roadmap of India's fintech revolution, now after covering that long distance, rightly or wrongly, with compliance regulations being ignored or not complied with in full measure, you've now been left on the wayside, and you come back into being another Me Too player, competing with those whom you had actually shown the direction to. So obviously, that becomes a major problem for Paytm. I think what we do understand for now is that in any case, Paytm or 197 Communication has not been a profit-making machinery for a while. So its EBITDA loss came in at about 170, 180 crore rupees or so. Now Paytm itself has come on record immediately after the Jan 31st RBI order, saying that the operating margin or the operating losses in fact could swell up to as much as about 500 crore rupees. So we pretty much know that the revenue driver has been the Payments Bank, and without the Payments Bank, there isn't much room left for too many revenue drivers, because then again it becomes a game of number of people who have installed your app, what are the ads you can serve them, what is the click-through rate, etc. So you pretty much become another platform where ad revenue, code share, discount coupons, all of these become part of your revenue drivers. And then of course ONDC could be one more aspect that Paytm can look at, the fact that Paytm in addition to phone pay,
a startup.
Yeah, exactly, and
to
has
onboard
been
more people on
has
ONDC.
been using the ONDC architecture to deliver food services, for example. So that is something that may get it to then compete in another market where you already have two more big boys of food delivery aggregation, being Swiggy and Zomato. So that could be one area that Vijay Shekhar Sharma could be looking at right now. But I mean, honestly, all of this is just
writing off
crystal ball
Paytm
gazing.
finally?
No, I'm not writing off. I don't think I have the authority and the experience to write off the entity. I'm just trying to see it as logically as I can right now, that what are the options available? Because if your revenue drivers dry up, then what do you have left?
Absolutely.
With your technology, what can you do? With your customer base, what can you do? And with the partnerships that you forged with, let's say, aspects or avenues like ONDC, how can you sort of, further augment those and still keep yourself ticking?
Permutations and combinations done
much.
here by Kartik, it does appear that Paytm has very little to no avenues if payment bank's license were to be revoked or cancelled. It looks like an eventuality in days and weeks to come, but clock ticking for Vijay Shekhar Sharma as well as Paytm Payments Bank. The license could be cancelled come 29th of February, which is the deadline set by RBI for stopping the onboarding of new customers. But with that, we've come to the end of this show. Thank you very much for watching.
वर्ष 2070 तक भारत नेट जीरो का लक्ष्य हासिल करेगा.
There is certainly a wall of capital coming into the clean tech, climate tech space, not just in India but across the world.
This and more, streaming on world's first news OTT, News 9 Plus. Download now.
A defiant performance by Ten Hag's men. Now standing at 7 feet 4 inches, Satnam Singh is making his